China's trading boom and the gold rally, coincidence or market trigger? What if the surge in gold prices isn't being driven by central banks, nor by inflation fears, nor even by geopolitical tension? What if the real force sits elsewhere, inside China's rapidly expanding trading desks, where leverage is rising, speculation is accelerating, and capital is moving faster than regulators can respond? Is this a disciplined allocation shift, or the early stage of a speculative wave that could reshape global liquidity flows overnight? Because if this rally is structurally driven, it's opportunity, but if it's speculation fueled, it's a warning. And the difference between the two could define the next decade of wealth transfer. Welcome to Boring Currency Index, where noise is filtered out and capital flows are decoded. If you are someone who has seen multiple cycles, who remembers real inflation, real crises, real market corrections, then this channel is built for you. Subscribe, not for excitement, but for clarity. And tell us in the comments, where in the world are you watching from? Gold did not begin rising in isolation. Behind the visible price movement, something deeper was unfolding inside China's financial system. What appeared on the surface as a normal rally was, in reality, connected to a sharp increase in trading activity across mainland exchanges. In recent years, Chinese investors had changed their behavior. Traditionally, many households in China preferred real estate. Property was seen as stable. It was familiar. It was trusted. But as the property sector weakened and confidence declined, capital began searching for alternatives. Gold became one of those alternatives. At first, the shift looked defensive. Investors were protecting savings. They were reacting to slower economic growth, currency pressure, and global uncertainty. This type of demand is common during fragile periods. It is slow, steady, and cautious. But then something changed. Trading volumes on Chinese commodity exchanges began to rise at an unusual speed. Retail participation increased sharply. Leverage usage expanded. Margin financing grew. The behavior no longer looked purely defensive. It began to resemble momentum trading. Momentum trading is different from long-term investment. It feeds on price acceleration. When prices rise, traders increase exposure. Rising exposure then pushes prices higher. That cycle can continue longer than expected, until liquidity shifts. Chinese exchanges became more active than many Western analysts anticipated. Domestic investors were not just buying physical gold products, they were actively trading futures contracts. Short-term positions multiplied, price swings widened. From a global perspective, this mattered. China is one of the largest gold consumers in the world. When trading activity intensifies inside such a large market, global price discovery becomes affected. Even if the original driver is local sentiment, the impact spreads internationally. At the same time, capital controls inside China restrict the movement of money overseas. This often forces domestic liquidity to circulate within available financial instruments. When equities weaken and property slows, speculative attention can move into commodities. Gold, because of its liquidity and historical reputation, becomes a natural magnet. However, there is a critical distinction between structural demand and speculative demand. Structural demand is long-term. It reflects strategic allocation decisions by institutions or central banks. Speculative demand, on the other hand, reacts to price movement itself. It can reverse quickly. Observers began asking a serious question. Was the gold rally being supported by lasting structural forces or by a wave of short-term trading enthusiasm inside China? Data suggested that trading turnover was rising faster than physical delivery demand. This imbalance is important. When futures activity expands more rapidly than physical buying, volatility often increases. Price movements become sharper. For business leaders and investors, this creates both opportunity and risk. If the rally is supported by strategic reserve accumulation and long-term wealth protection strategies, it may continue in a controlled manner. But if leveraged speculation is driving price acceleration, the structure becomes fragile. Fragility in markets does not announce itself clearly. It builds quietly, leverage expands silently, risk exposure concentrates gradually. Then, when sentiment shifts or policy changes, liquidation can happen quickly. China's regulators have historically intervened when excessive speculation threatens stability. They adjust margin requirements. They limit position sizes. They slow trading activity. These actions can cool a market rapidly. Therefore, the gold rally cannot be analyzed only through Western monetary policy or global inflation data. It must also be examined through the lens of Chinese trading behavior. For entrepreneurs and capital allocators, the lesson is strategic. Price alone does not explain risk. The source of price movement explains risk. If trading volume expansion is driving the rally, volatility may remain elevated. If liquidity conditions tighten domestically, speculative positions could unwind. At this stage, the gold market stands at an intersection. On one side lies structural realignment, long-term capital shifting toward hard assets. On the other side lies amplified speculation, fast-moving capital chasing momentum within controlled liquidity channels. The distinction between these two forces will determine whether the rally matures into a sustainable trend or transforms into a cycle of sharp corrections. Understanding that difference is not optional for serious decision makers. It is essential, because when liquidity concentrates in one direction, the next movement is rarely random. While global analysts debated inflation, interest rates, and central bank policy, a quieter mechanism was operating beneath the surface. The gold rally was not only about fear or protection, it was also about liquidity rotation. China's financial environment had entered a sensitive phase. Economic growth was slower than previous decades. Property markets were under pressure. Private sector confidence was uneven. In such an environment, domestic capital does not disappear. It reallocates. When traditional investment channels weaken, liquidity seeks mobility. It searches for markets where price movement is active and participation feels accessible. Gold, traded through domestic exchanges and financial platforms, offered that accessibility. Retail investors began increasing their exposure through futures contracts and structured products. Unlike physical gold buyers, futures traders can amplify positions using margin. This means they control larger exposure with smaller capital. Leverage, when used widely, transforms normal demand into accelerated price momentum. This dynamic creates a liquidity engine. Each price increase reinforces confidence. Rising prices attract new traders. New traders push volume higher. Higher volume increases volatility. Volatility then attracts short-term participants seeking opportunity. The cycle feeds itself. However, the deeper question is not whether prices are rising. The deeper question is why liquidity is concentrating in gold rather than other assets. Chinese equities had faced periods of instability. Regulatory changes in previous years had altered investor sentiment. Meanwhile, capital outflow restrictions limited diversification abroad. Under these conditions, domestic investors often concentrate capital within permitted markets. Gold benefits from this structure. It is internationally priced but locally tradable. It carries historical trust. It aligns with wealth preservation instincts. Yet at the same time, it allows speculative exposure. Institutional players also began increasing activity. When retail momentum builds, institutions often respond strategically. Some hedge risk, others provide liquidity, some participate directly in trend amplification. The result is layered participation. Retail momentum at the base, institutional positioning above it, exchange volume expanding across the board. From a strategic perspective, this is where risk evaluation becomes critical. If liquidity concentration is primarily speculative, the system becomes sensitive to policy shifts. Chinese regulators closely monitor excessive leverage. When price movements appear detached from economic fundamentals, intervention becomes possible. Margin requirements can be raised, trading limits can be tightened, position caps can be enforced. Each of these tools can slow speculative acceleration rapidly. History shows that Chinese commodity markets have experienced sharp reversals following regulatory tightening. The pattern is consistent. Volume surges, leverage builds, policy response follows. For business leaders and entrepreneurs observing this rally, the signal is clear. Price momentum without structural backing carries reflex risk. At the same time, one must acknowledge the strategic context. China has been diversifying reserves over the past decade. Gold plays a role in long-term monetary positioning. Central bank accumulation provides a structural floor beneath the market. This dual-layer structure complicates analysis. On one layer, structural reserve allocation supports price stability. On another layer, leveraged speculation amplifies short-term movement. When both forces operate simultaneously, markets appear strong. But stability depends on which force dominates. If structural demand outweighs speculative leverage, corrections remain controlled. If speculation becomes dominant, volatility expands. International markets are not isolated from this dynamic. Global gold pricing reflects aggregate flows. A speculative surge in China can influence sentiment worldwide. Western traders respond to price acceleration. Exchange-traded funds adjust positions. Cross-border liquidity transmits signals quickly. Thus, what begins as a domestic trading surge can evolve into a global narrative. The risk for global investors lies in misinterpreting the source of the rally. If they assume structural stability while the underlying driver is short-term leverage, positioning errors may occur. Liquidity cycles often appear strongest just before inflection points. When participation becomes crowded, exit pathways narrow. At this stage, China's trading boom in gold represents both opportunity and vulnerability. It demonstrates capital agility. It reflects domestic adaptation. But it also introduces systemic sensitivity. The market is not simply rising. It is being fueled. And when markets are fueled by concentrated liquidity, the most important question is not how high they can go. It is how stable that fuel truly is. Markets often move on emotion in the short term, but they survive on policy in the long term. Inside China, policy is not a background factor. It is a central force. And when trading activity expands rapidly, policy does not remain passive. Gold's rise during China's trading surge cannot be separated from regulatory oversight. Chinese authorities maintain tight supervision over capital markets. They monitor leverage, speculative excess, and systemic risk closely. Stability is not optional in their framework. It is mandatory. When volume increases too quickly, questions begin to form within regulatory institutions. Is this capital seeking protection, or is it chasing momentum? Is leverage expanding beyond sustainable levels? Could volatility spill into broader financial confidence? These are not theoretical questions. They influence real decisions. China's regulators have historically demonstrated willingness to intervene in commodity markets. In past cycles, when coal, steel, or agricultural futures experienced extreme volatility, exchanges responded by raising margin requirements and limiting speculative positions. The objective was clear: slow the momentum before instability spreads. Gold is different in symbolism, but not in systemic importance. If trading leverage expands rapidly and volatility accelerates, authorities may adjust rules to cool the market. Even minor changes, such as increased margin ratios, can alter risk-reward calculations for short-term traders. When leverage becomes more expensive, speculative enthusiasm often declines. This introduces a powerful uncertainty into the current gold rally. The rally is not occurring in an unregulated environment. It exists within a controlled financial architecture. For business leaders and entrepreneurs, this distinction matters deeply. In Western markets, price discovery is often decentralized and driven by institutional capital. In China, price discovery exists within a framework that balances growth with systemic stability. When speculative behavior threatens balance, policy tools are activated. This creates a structural ceiling on unchecked momentum. However, policy also operates in another direction. China has strategic reasons to support gold accumulation. Diversifying foreign reserves reduces exposure to external currency risks. Increasing gold reserves strengthens long-term monetary positioning. In an environment of global uncertainty, gold aligns with national financial resilience. Therefore, policy influence in this market is not one-dimensional. On one side, regulators may restrict excessive speculation. On the other side, strategic accumulation may continue quietly in the background. This dual influence creates complexity. It prevents simple conclusions. If speculative trading drives short-term acceleration, policy tightening could introduce sudden corrections. If strategic reserve allocation dominates, corrections may remain shallow. For global observers, this balance is difficult to measure directly. Official data provides partial visibility. Trading volume offers clues. Price behavior suggests intensity, but the precise weight of policy intention remains less transparent. Entrepreneurs studying the situation should focus on one principle. Markets shaped by policy carry different risk dynamics than markets shaped purely by sentiment. In a policy-sensitive environment, timing becomes critical. Momentum strategies require awareness of regulatory signals. Long-term positioning requires understanding national strategic priorities. The gold rally, viewed through this lens, becomes more than a price event. It becomes a reflection of domestic financial adaptation under controlled conditions. Meanwhile, international investors often interpret gold through inflation expectations and interest rate forecasts. They may underestimate the domestic regulatory variable inside China. This can lead to misaligned positioning. When policy influence intersects with speculative liquidity, markets can pivot quickly. Announcements do not need to be dramatic. Small adjustments can shift leverage costs. Shifted leverage costs can alter participation. Altered participation can reshape price momentum. At this stage, the gold rally stands under silent observation. Authorities are watching leverage. Traders are watching price. Institutions are watching flows. And in markets where oversight remains active, the most important risk is not visible volatility. It is the moment when stability becomes a policy priority. At this stage, the central question becomes unavoidable. Is China's trading boom in gold signaling a long-term structural shift in global capital allocation, or is it amplifying a temporary liquidity cycle that will eventually reverse? For serious decision makers, this distinction defines strategy. Gold has always carried dual identity. It is both a defensive reserve asset and a speculative instrument. When structural uncertainty rises, currency instability, geopolitical tension, debt expansion, gold gains legitimacy as protection. But when price momentum accelerates rapidly, it also attracts short-term capital-seeking quick returns. China now sits at the intersection of these two forces. On the structural side, several factors support continued gold relevance. Global debt levels remain elevated, major economies face fiscal pressure, currency diversification has become a strategic objective for many nations. In this context, gold serves as a neutral reserve asset. China's long-term reserve strategy aligns with this logic. Gradual accumulation strengthens balance sheet resilience. It reduces exposure to foreign policy risk. It builds monetary optionality. If this structural motive dominates, Gold AS rally may represent the early stage of a broader capital realignment, one that extends beyond retail trading activity. However, the speculative layer cannot be ignored. Trading data indicates heightened short-term participation. Rapid turnover, increased leverage, and strong price sensitivity suggest that part of the rally is fueled by tactical positioning rather than long-term allocation. Speculative liquidity behaves differently from strategic capital. Strategic capital moves slowly. It absorbs volatility. It seeks stability. Speculative capital moves quickly. It amplifies volatility. It exits rapidly when conditions change. When both forces coexist, price strength can appear convincing, but sustainability depends on balance. If speculative positioning becomes crowded, vulnerability increases. Crowded trades are efficient on the way up, but fragile when sentiment shifts. Several catalysts could alter sentiment. Domestic economic stabilization could redirect capital back into equities or property. Regulatory tightening could reduce leverage participation. Global monetary adjustments could influence currency expectations. Even modest shifts in any of these variables could reduce momentum intensity. Entrepreneurs and business leaders observing this landscape must avoid binary thinking. The situation is neither purely structural nor purely speculative. It is layered. Strategic insight requires understanding which layer is expanding more rapidly. If reserve accumulation and long-term allocation continue steadily while speculative excess remains contained, the gold rally may mature into a stable, multi-year trend. If speculative activity expands faster than structural demand, volatility will likely increase. Corrections could become sharp. Liquidity could thin quickly during reversals. The broader implication extends beyond gold itself. China's trading surge reflects domestic financial adaptation in a constrained capital environment. It demonstrates how liquidity concentrates when alternatives narrow. It highlights how local trading dynamics can influence global asset pricing. For global markets, this serves as a reminder. Price movements are not always driven by the most visible narratives. Sometimes, the real driver operates quietly within domestic systems, reshaping global flows indirectly. The gold rally, therefore, becomes a case study. It reveals how capital seeks protection during uncertainty. It shows how speculation accelerates trends. It illustrates how policy oversight shapes boundaries. And it reinforces a strategic lesson for decision makers. Understanding who is driving price is more important than understanding where price is moving. At this point, the gold market is not simply reacting to inflation or geopolitics. It is responding to a combination of domestic liquidity concentration, policy awareness, and structural reserve positioning inside one of the world's largest economies. Whether this becomes a sustained reallocation of global wealth or a contained cycle of leveraged enthusiasm will depend on the interaction of those forces in the months ahead. For those managing capital, the objective is not prediction, it is preparation. Because when liquidity flows shift direction, they rarely give advance notice.